Okay. So, hi everyone. It's very nice to see you today. So today, as Stuart said, we are going to be talking about if taking money from VCs is actually going to bed with snakes. There is a lot of risks and opportunities, obviously, with doing this. And people say a lot about also bad things about VCs, that they take control, and there is also misaligned incentives, but we'll see. So my name is Przemek Kowalczyk. I raised from many VCs in my startup journey, I think around 10 of them, and my guests are Blake. If you could say a few words about yourself.
Hi, everyone. Pleasure to be here, and thank you for having me. My name is Blake Lezensky. I'm the head of corporate innovation at Outlier Ventures. We are the biggest Web3 accelerator globally. I've had the pleasure of running about 5 accelerators by now, which means about 40 projects we invested in, out of the portfolio of 320. And I'm also an angel investor in about 20 projects myself. Great pleasure to be here, and very excited to meet my fellow panelists.
Hello. My name is Julian Zawistowski. Back in 2016, I conducted like a token sale for the Golem project, which was like a big thing back then. That was before token sales were fashionable. So we were like at the beginning of the exponential growth with that. Well, and I guess this is why I'm here. At the moment, I'm director of Golem Foundation, which is a spin-off of the original Golem project, and our main activity is Octan, which is also like yet another way of funding things in Web3 space.
Cool. I'm Michał. I'm an investor at Market One Capital, which is a classic VC firm. We invest in both Web2 and Web3 companies because ultimately we focus, our specialty is focusing on networks. And you have them in both Web2 and Web3 environments. We manage currently under around 140 million euros. We know each other with Przemek, I think, since Ramp was called Supposo in 2018, so a long time ago. And I think I mean, not only me, but as Market One, we passed 1 or 2 times on Ramp, which brought us to many learnings.
Thanks. So the first question, without further ado, would be to Michał and Blake. When, let's say I'm a founder and I want to raise capital or start new project, how should I think about, should I take VCs or should I not?
All right. So, of course, my snaky opinions are not official opinions of Outlier Ventures and not financial advice. I think you shouldn't even start thinking about raising capital in the beginning. A lot of people kind of put it first, thinking that this is the first step. But in my eyes, you need to complete your team. You need a rudimentary version of your product. You need to get some indications of the product market fit, some traction. Only then you can start considering it. But if the market is craving for what you're offering and you start getting clients in, I will always tell you prioritize clients over investors. I think a lot of people don't realize that raising money is not just getting cash in your bank that you can then use at will. It's actually making a big promise that you will have to deliver on. That's why I always try to highlight that raising more money, even though it looks great in the papers and, it gives you an ego boost and, of course, likes on social media, in the end of the day, that also means you made a bigger promise. If you don't deliver on it, that means your reputation might be tarnished, and it's going to make things harder for you down the line. At some point, you might need VC funding, but I would really make sure not to start with that and focus on fundamentals first, and only do it when you really have to.
Yeah, I tend to agree. I think ultimately it's a very personal question, or maybe not. I mean, it's a question for funding team, whether they want to build a sustainable company or whether they want to, they crave to eat the world, because I think VC is a leverage to realize your huge ambition, right? If you want to have, positive EBITDA company, you don't need money from VC or from other actors, maybe from some BAs. So ultimately, it's a question of of where do you want to be with this company, right? And ironically, in crypto, the biggest two projects that are out there, Bitcoin and Ethereum, didn't raise VC money. So it's possible also to achieve great outputs with no VC money. Historically, in Web 2, whether this is Google, Oracle, hundreds of other companies, they were using VC capital, right? VC capital ultimately is there to help you go faster, to also increase economy, risk appetite, to innovate, which from macro perspective brings some competitive edge to economies worldwide, right? And even though it's extremely inefficient vehicle, VC, it's still most efficient innovation vehicle out there. Prove me wrong. I'll gladly hear that.
So maybe to be more specific, what would be the cases when you shouldn't raise from VCs?
Yeah, so especially with current productivity gains, I think yesterday there was this report based on many companies, but predominantly on Microsoft with the code writing boost with copilots, etc. Also, you got this interview of Salt Altman that there will be one person, 1 billion valuation company. I think this area where you need VC money is only getting smaller and smaller. So that's a bit problematic for the industry, I think, in the longer term. But we see plenty of companies that are building some tooling, not necessarily on whole networks, right? But supporting solutions for already commercially active networks. And I think for that you don't need money, right? Or you need very little, and can be friends and fools and family, right? Which have very different expectations, right? As Blake mentioned, with VC, there's this expectation that your company will return the whole fund, right? The power law applies whether this is Web 2, Web 3, or probably also for Web 4. That because it's so risky, you can have the same logic as you have in private equity, right? That you assume that majority of companies in your portfolio will return 2 to 3x. In VC, especially at the early stages, you bet that one company, maybe two companies out of 20 to 40 in the whole portfolio will return the whole fund, right? And it's very different dynamic, very different logic. And I think it's critical for first-time founders to understand it when they go to the market, right? That you have this expectation. Typically, this expectation results in over 1 billion valuation marks.
So we have one person on stage who have not raised from VCs. Julian, as you probably all remember, he raised through, as you said, ICO in 2016 for the Golem project. Back then it was around, I think, over 800,000 ETH. Back then valued at 10 mil. Everyone can check by themselves how much this would be worth today. Julian, so when you look back at this decision, how do you think about it? Was it right one, or maybe you would do something differently?
Well, I think that needs me to return to the previous question, obviously. And my answer to the previous question is that that obviously depends on what you want to do. So what's your business model? And in a Web3, I think there are things that go pretty well with the venture funding, and think that do not really match that type of funding. And you said Bitcoin and Ethereum. So the great question is would Ethereum be what it is if it had venture funding at the beginning? I think Ethereum wouldn't be a thing if it had a venture funding at the beginning. On the other hand, the highly
why is that? Why you say that Ethereum the same?
Well, this is of course a highly speculated a what if discussion, but I think in Web3 things are governed by social phenomena. So Ethereum is where it is mostly because it had so many people building on top of it. And that happened because that was a quite massive movement, which had momentum from the very beginning, and it was because of the type of funding it had. So with the token sale, by the way, I hate like an ICO term, for many reasons. Whatever. I think Ethereum called what they did crowdfunding, and in a way it is what it was. So yeah. So I don't think they would be there where they are at the moment, where we are. On the other hand, like a Coinbase is like the perfect example of like a highly successful company, which I don't think would be able to finance its growth through anything like a token related. Coming back to your question, it's so loaded, and I have to remind you that since 2019 I'm not part of the core Golem team. Back then, we considered token sale as a kind of a public goods funding way of raising capital, and we didn't have any business model for Golem the company that would eventually make its shares worth a lot, which would be interesting for venture investors. Of course, we could think about a business model that would result in something like that, but of course that comes at a cost, and this cost very often for type project would be not compatible with what we believe that a decentralization, we would say Web3 right now is about. So I don't think there was any other way of raising funds back then for that type of project. Also, what we did then was a half a year or a year before all the ICO mania of 2017. Well, a lot of people watched us, and others early adapters for that, and then followed us, which resulted in ICO mania. I will use that term this time, and I don't think it was a good thing. I think things got derailed a little bit. Of course, the problem both of venture funding and of token sales is that most of the times is driven by greed, and this is what it is. This is a capitalistic system. This is obvious that venture funds invest because they want return, and people buy tokens because they want return. But things can get quite tricky with that attitude, especially when we are talking about a token and this whole Wild West, which it still is. Maybe not as much. Doesn't that answer your question?
Yeah, thank you. So the token sales and ICOs still are with us today. They are less popular than, as you said, in 2016 during the ICO mania, or 17. And I'm curious, how do you think about those existence of token sales in the Web3 ecosystem? Do you think this has its own purpose, or this is just the effect of the lack of regulation in the space? Maybe Blake, because you I think invest in tokens as well.
So I think it's a really good question, but I think the answer is both. It's both a feature and it's caused by the unregulated environment. I really like the point that you made about the Wild West of technology that we're definitely still are in. And that means that you get the smartest, bravest people that innovate, but it also means you get really smart scammers in the mix, or snake oil salesmen, to pun on the title of the panel. So you have different instruments in Web3, different ways of raising. Even if you're doing a TGE, nowadays, it's not the same that you just launch straight into it. Most likely you took some institutional funding through simple agreements for future tokens before that. So TGE is not really what it used to be. That is also evolving as an instrument, token generation event. Investors in Web3 might be more susceptible to hype cycles. There are moments, let's say a couple of years ago, they would be throwing money at just a pitch deck. But then when the market goes down, suddenly they become very prudent. And I think it's really important to understand that in Web3, something that is usually very gate-kept, here it's more democratized, and that causes its own risks. But in the end of the day, I think the key question, if you're considering what instrument to use, whether to go for a token, and a question that if you cannot answer with confidence, you shouldn't be raising VC funding, is where the value accrues in your business model. You mentioned that for Golem, you didn't have a clear answer to that question, but that was very different times. So nowadays, if you want to raise through a token, but it's unrelated to your business model, well, that might even get you in legal trouble. So you need to be very mindful, because that raise and the instrument you pick will have a lot of implications further down the line. Because it's an unregulated environment, it doesn't mean there is no legal risks. It actually means you need a much bigger legal brain to navigate that Wild West environment that we're in.
Well, we didn't have like a business model for the company value, not necessarily token. So I believe that we need a lot of different like funding strategies for Web3, because a lot of things that are created that needs to be created are not compatible with the VC funding or like a capital funding in general, like through the company that is successful and is worth more. I don't think token sales are the only answer. I don't even think they are the best answer. The problem is that this is all still like a highly experimental, and we at the moment we are like experimenting with how to fund things in a sustainable way that makes sense. So I don't think this is only because of the lack of regulations and just people doing stupid shit because they can. Definitely not. There are a lot of projects with like a great business models that is embedded in tokens or in other like phenomena of the Web3 that are just great. And of course, some of it is possible also because this is not regulated, as you said. This is like a Wild West, and you have like smart people innovating. And in general, I think as a space, if we are to be successful, we need new funding models for things, because like VC funding and also like a token sales do not cover like all the use cases that really needs to be.
So you're basically starting to compete with the guys here.
Oh, I don't think so. I think that if the funding is not compatible, then it's not compatible. So if your business model excludes a VC funding, then you just take a look for different sources of funding. And then if you are like a VC compatible, that's great, and you can do that, and probably you will be able to move faster, and easier in many ways.
Yeah, so to token or not to token, for me, the more fundamental question is whether this provides any source of defensibility in the long term, right? Because if you do token for virality to gain some traction early on, I think this proved historically to be a wrong approach, and you had couple of examples of this. Even the one that was kind of mixing Web3 and Web2 was Brain Trust, right? Which was like the recruitment network, and it was at certain point like great success of a practicality of crypto, and 5 months or 6 months later it was pretty much dead, right? So I think and there's great piece about not really building network effects with tokens, which should be the case for that's a premise of crypto, of those networks. By Samir Singh, if you're interested, let me know. I will send you a link. He focuses on solely for the last 6-7 years on network effects. Also, that's my perspective, so it's a bit skewed, right? So virality, from my opinion, doesn't really work if you want to fundraise just for the sake of fundraise, that you want to crowdfund, right? I think it's all right, but I think it's important that you remember that once you fundraise this way, you build in public, right? And you have to attach what your promises to those that to the crowd, right? Which in many cases is not the best for long-term position of the company in the market. Staying private longer, or maybe not even longer, because I think in crypto we don't have the issue of staying private too long. I think it's quite the opposite, right? So compared to public markets right now, stock exchanges. So I think if you go too early, it kind of skews your product roadmap to make your let's say shareholders happy versus to build best product available and kind of postpone this this reward for another, I don't know, 5-10 years and to be a monopoly, because ultimately you want to be a monopoly, right?
So, thank you. So let's go back down to earth because the time is almost up. So in a few minutes in the room next door, there is going to be a pitching session of the couple of, I think, 20 startups pitching in front of the VCs. What would you say to those founders who are, starting the journey, thinking about raising capital, what pitfalls to avoid, how to navigate this sea of snakes?
So first advice and then pitfalls, right? Especially for the startups pitching, don't try to oversell it, because VCs, they're being sold to all the time, so they will see through that. Think of it as a conversation with a friend, maybe a friend that's not as smart as you, and you just have to explain all of it. But also remember that over-explaining is also not a good idea. Give us enough for us to ask questions, but if you over-explain and everybody just nods their heads and they say like, great, probably means they're not interested. If they're asking hard questions, that means they're actually considering investment. And to talk about some of the pitfalls, something that might come with VC presence further down the line, well, VCs are not doing this as charity. They have their own goals. So sometimes they might pressure you to grow, where you should actually be looking deeper into your product, deeper into gaining profitability, because they have their KPIs to hit. Another thing you should consider is founder dilution. Remember that as a founder, you might think that, you have a co-founder, you might think that you own 50% of the company, but if you run the math, that's not actually true. Because further down the line, you're going to have to sell a lot of it for the VC capital. And if you sell a lot of it too early, that means you're unable to get more money further down the line. So again, raising too much early not only is a big promise, it's actually selling something that will gain value with time, and you should be mindful of that. And finally, I think you need to be really careful about misalignment of incentives around tokens. At Outlier Ventures, we try to be very, very, very ethical around it. If a project comes to us, and they're great and they're amazing, but the token doesn't fit the business model, there is nothing for the token to do there, we would never push the founder to do a token or structure a token against the long-term interest of the project. But there are actors in the market that are very focused on the early liquidity from token investments. And I have heard some cases where essentially a big fund comes to a lot of projects at once and they tell them, hey, can you do a token? And they're like, well, I'm not sure. Can you do it next month? And it's clear that they're thinking about their vesting schedules, and when they can liquidate the tokens, they're not thinking about the long-term interest. And then maybe last pitfall, which is on the side of the founder, be really mindful how you spend the money, especially when you get that first, big funding, you get super excited. And I've seen some horror stories. I've seen people that their first hire was a founder PA because now they're so important. And then they spend the time spending the money on their travel budget and flexing on Instagram. And your investor actually follows you on Instagram, so they see that. And another case, also remember, there was a team that got a rather small ticket, but in the country where they were based, it was enough to kind of get them going. And the guy, even though they were pre-seed, they just kind of imagine they're a corporation now. And CEO was paying himself 10 times what he was paying others. And he said, like, no, I don't need other funding. I'm just going to get by on this. So again, there are a little sins that can be taking place on both sides of the funding table. But I think these are the most common pitfalls to avoid and be mindful of.
Yeah, I like to hear from founders secrets when they share a certain market product, whatnot, insight that's not available to the masses, right? That enables you, if you have distilled this market insight, whether this is acceptance of certain technology in the market or market observation or market behavior observation. This is competitive advantage, right? That enables you to build on. Because especially in our part of the region, if our part of the world, we don't have problems with building solid products, right? That's not the issue. I think we have much more issue with understanding the market, with communicating with the market than anything else. So that's what I like most. Second thing would be don't over optimize your early stage round. You will have your growth rounds for this when you come where the money is commodity. Obviously at early stages you still get 90% plus of what you're getting from the investor's money. Some of them will connect you with some actors, some will help some with tokenomics, etc., maybe with hiring, but they won't build this company for you, right? No matter you have a 16Z or regional investors on the rooster, right? Ultimately, what you should optimize for is the pace of iteration, right? This is the only thing that matters in early stages of a company. If you can iterate, if you're a team in iterating, in seeing what works with the market, I think you shouldn't be worried with investors. They will find you. I think mass majority of quality investors right now have certain platforms to track companies, how they grow, whether this is employee count, whether this is crypto usage activity, yada yada yada, right? If you deliver, then money will find you, because currently you are the precious thing in the market, not capital, right? And that's the case for the last 10 years at least, right? In 90s, early 2000s, it was quite the opposite, and founders were coming to VCs, which from today's perspective, this is quite obscure. Thankfully, it's like it is. I much more prefer current environment.
I will be short. So first, consider like a delay in going to VC, like if you can. So there is no rush. If you can run, if you can use different strategies, you can do that later. That's number one. Number two, like especially at the early stage, this is like a like a marriage. So you have to pick your investor like carefully. They will ask you questions, but you can also ask questions to determine like which VC is best for you. And sometimes it might be even better to get like a slightly worse deal, but from much better VC, which is much more aligned with what you can do. Because especially at the early stage, like the help that VC can provide you, if they are experts in the given area, it might be very valuable. So do not get too excited if you have like a first offer. This is like a market, and you are part of the market. You don't have to like take that because you're offered. Like pick your spouse like carefully.
And also I have a few words. So from my perspective, taking VCs, you also always need to remember that it's your business. You can allow others to invest in it. And you always need to remember that you are in the end responsible for its success. And you need to pick right to succeed. Okay, I think we're right on time. So thank you. We unfortunately don't have time for questions. But thank you, Blake, Michał, Julian, for coming here, and thanks everyone.
Thank you.